You know that feeling when you check your Bitcoin portfolio and your stomach drops? That moment when you see those red numbers staring back at you and you immediately start questioning every decision you've ever made? Maybe you're sitting there right now watching Bitcoin drop significantly and wondering if this is finally the end. Maybe everyone was right. Maybe you really should have listened to your uncle who said Bitcoin was a bubble back in 2017. Or maybe you're just angry at yourself for not selling at the top like that one friend who always claims to have perfect timing. My name is Joe, and I spend way too much time thinking about money, investment psychology, and why most people consistently do the exact wrong thing when markets crash. If you're someone who wants to understand what wealthy investors actually do during Bitcoin crashes, instead of panicking and selling at the bottom, make sure to hit that subscribe button and give this video a thumbs up if this information helps you make better decisions with your money. Here's something that might shock you. Every single time Bitcoin has experienced major crashes, the people who panic sold have been wrong every single time. Not sometimes, every single time. Now, I know what you're thinking. That sounds like survivor bias or some kind of selection fallacy. But the data is actually pretty clear when you look at it. Bitcoin has experienced multiple significant crashes throughout its history. And after every single one of those crashes, it eventually went on to reach new all-time highs. Sometimes it took months, sometimes it took years. But the pattern has been remarkably consistent. But here's the thing that drives me absolutely crazy. Despite this historical pattern, most people still do the exact opposite of what they should do during a crash. They buy when Bitcoin is at all-time highs and everyone is talking about it. Then they sell when it crashes and headlines are screaming about how Bitcoin is dead. It's like trying to time a roller coaster by getting on at the top and jumping off at the bottom. You couldn't design a worse strategy if you tried. The truth is, there's a massive difference between how average investors react to Bitcoin crashes and how wealthy, sophisticated investors handle them. And understanding this difference is what separates the people who build real wealth from those who just ride the emotional roller coaster and end up exactly where they started. Now, before we dive into what millionaires actually do during Bitcoin crashes, let me ask you something. When you see Bitcoin drop significantly in a short period, what's your immediate emotional reaction? Be honest with yourself. Do you feel fear, panic, regret? Or do you feel something else entirely? Maybe even excitement? Because here's the thing about emotions and investing. Your immediate emotional response during a crash tells you everything you need to know about whether you're thinking like an investor or thinking like a gambler. Most people feel fear and panic when they see red numbers. It's a completely natural human response. Our brains are wired to avoid losses. In fact, psychologists have found that the pain of losing money is roughly twice as powerful as the pleasure of gaining the same amount. This is called loss aversion, and it explains why so many people do exactly the wrong thing during market crashes. They're trying to avoid the pain of seeing their portfolio value drop, so they sell to stop the bleeding. But in doing so, they lock in their losses and turn what could have been a temporary decline into a permanent one. But here's what wealthy investors do differently. They've trained themselves to override that immediate emotional response and replace it with something else. Calculation, logic, strategy. They understand that market crashes are not threats, they're opportunities. And this fundamental shift in perspective is what allows them to build wealth while everyone else is panicking. Think about it this way. Imagine you own a successful business that generates $100,000 in profit every year. One day, someone offers to buy your business for $500,000. You probably think that's a pretty bad deal, right? You're giving up a business that generates $100,000 annually for only 5 years of profit. But then imagine the next day, that same person comes back and says they'll only pay $250,000 for your business. Would you be upset? Would you panic and think your business is suddenly worthless? Or would you recognize that nothing about your business has actually changed? It still generates $100,000 in profit every year. The only thing that changed is the price someone is willing to pay for it. This is exactly what happens during Bitcoin crashes. The fundamental properties of Bitcoin don't change. The supply is still fixed at 21 million. The network is still secure. The monetary policy is still programmed into code. The only thing that changes is the price people are willing to pay for it right now. And wealthy investors understand that this temporary price dislocation is actually an opportunity to acquire more of an asset they believe in for a lower price. Now, let me walk you through exactly what wealthy investors do when Bitcoin crashes. And I want you to pay close attention because this is where most people get it completely wrong. The first thing wealthy investors do during a Bitcoin crash is absolutely nothing. They don't panic. They don't check their portfolio every 5 minutes. They don't scroll through Twitter looking for reassurance or confirmation bias. They simply sit on their hands and wait. Now, this might sound incredibly boring, but here's why it's so important. Your brain is literally wired to make bad decisions when you're under stress. When you see your portfolio value dropping, your fight or flight response kicks in. Your cortisol levels spike, your ability to think rationally diminishes. And in that state, you're much more likely to make emotional decisions that you'll regret later. Wealthy investors understand this about themselves. They know that their own psychology is their biggest risk during a market crash. So they remove themselves from the situation. They don't make decisions when they're emotional. They don't make decisions when they're stressed. They wait until the initial panic subsides and they can think clearly again. This simple practice of doing nothing during the height of a crash is probably the single biggest advantage wealthy investors have over average investors. The second thing wealthy investors do during a Bitcoin crash is they actually look for opportunities to buy more. Now, I know this sounds completely counterintuitive. Why would you buy something that's dropping in value? But here's the key insight that wealthy investors understand. They're not buying Bitcoin for next week or next month. They're buying it for 5 or 10 years from now. And when you're thinking in terms of years rather than days, a significant drop in price starts to look like a sale rather than a disaster. Let me give you a specific example to make this concrete. Imagine you have $10,000 to invest in Bitcoin. You could buy at the current price of $100,000 per Bitcoin and get about 0.10 Bitcoin. Or you could wait for a crash and buy at $60,000 per Bitcoin, which would give you about 0.17 Bitcoin. That's nearly 70% more Bitcoin for the same amount of money. Now, if you believe Bitcoin will be worth significantly more 5 or 10 years from now, wouldn't you rather own 70% more of it? This is exactly how wealthy investors think. They view crashes as opportunities to accumulate more of an asset they already believe in at a discount. But here's the crucial part. Wealthy investors don't just buy blindly during a crash. They have a specific strategy for how and when to deploy their capital. And this strategy is based on math, not emotion. The most common strategy wealthy investors use is called dollar cost averaging, but with a twist during crashes. Instead of buying the same amount every month regardless of price, they increase their purchases when Bitcoin drops below certain thresholds. For example, they might have a plan to buy more if Bitcoin drops from all-time highs and increase their purchases even more as the price continues to decline. This strategy is based on the mathematical reality that buying more when prices are lower improves your overall cost basis and increases your potential returns when prices eventually recover. Now, you might be wondering how wealthy investors know when to deploy this extra capital. Do they try to time the exact bottom? Do they use some kind of technical analysis or crystal ball? And the answer might surprise you. They don't try to time the bottom at all. Because here's the secret that most people miss. Nobody can consistently time the exact bottom of a market. Not even the most sophisticated investors with billions of dollars at their disposal. What wealthy investors do instead is they scale into their positions over time. Let me explain what I mean. Imagine Bitcoin has crashed significantly from its recent highs. Wealthy investors won't dump all their available capital into Bitcoin at the first drop, hoping they found the bottom. Instead, they might scale into their position over time. They might buy a portion of what they plan to invest at the first significant drop, another portion if it drops further, another portion if it continues to decline, and the final portion if it drops even more. This approach has several advantages. First, it removes the pressure of trying to time the exact bottom. Second, it gives them exposure to potential upside if Bitcoin recovers quickly. And third, it protects them if Bitcoin drops even further than they expected. This strategy of scaling into positions rather than going all in at once is something I see wealthy investors do consistently. They understand that being right about the long-term direction of an asset is more important than being right about the exact timing of their entry point. And this mindset allows them to sleep well at night, even during massive market crashes. The third thing wealthy investors do during Bitcoin crashes is they actually increase their research and due diligence. Now, this might seem strange. Why would you spend more time researching something when the price is crashing? Shouldn't you be running for the exits? But here's the thing wealthy investors understand. Market crashes are actually one of the best times to learn about an asset because that's when you find out what's really going on beneath the surface. During bull markets, when prices are going up and everyone is making money, there's a lot of noise and hype. Everyone has an opinion. Everyone is an expert. But during bear markets and crashes, the weak hands get shaken out, the hype dies down, and you're left with people who actually understand what they're investing in. This is when wealthy investors pay the most attention. They look at things like on-chain metrics. How many new addresses are being created? What's happening with transaction volume? Are long-term holders selling or accumulating? They look at fundamental developments. What's happening with Bitcoin adoption? Are more companies and institutions getting involved? What about regulatory developments? Are governments becoming more or less hostile toward Bitcoin? They look at macroeconomic factors. What's happening with inflation, interest rates, the broader economy? This intensive research during crashes serves two purposes. First, it helps wealthy investors determine whether the crash is justified by fundamentals or whether it's just irrational panic. If nothing has fundamentally changed with Bitcoin and the crash is purely emotional or driven by temporary factors, that's actually a buying opportunity. But if something fundamental has broken, if there's a real problem with the technology or adoption or regulation, then that's a reason to reconsider their thesis. The second purpose of this research is psychological. When you've done your homework and you understand what you're investing in at a deep level, you're much less likely to panic during a crash. You have conviction in your investment thesis because it's based on research and logic, not hype or fear. This conviction is what allows wealthy investors to hold their positions and even add to them when everyone else is selling. Now, here's something that might surprise you about wealthy investors and Bitcoin crashes. They actually prepare for crashes before they happen. They don't wait until Bitcoin is already down 40% to figure out what they're going to do. They have a plan in place beforehand. This plan typically includes several key components. First, they have cash reserves set aside specifically for buying opportunities during crashes. They don't invest every dollar they have during bull markets. They keep some powder dry so they can take advantage of sales when they happen. This is a fundamental principle of investing that most average investors completely ignore. They invest everything they have when prices are high and have nothing left to buy when prices are low. Wealthy investors do the opposite. Second, they have predetermined price levels at which they'll increase their purchases. They might have a written plan that says if Bitcoin drops below 50,000, I'll buy X amount. If it drops below $40,000, I'll buy 2X amount. If it drops below 30,000, I'll buy 3X amount. This removes the need to make emotional decisions in the heat of the moment. The decision has already been made calmly and rationally when prices were stable. Third, they have rules for when they'll sell. And here's the key insight. These sell rules are not based on price drops. They're based on fundamental changes in the investment thesis. Wealthy investors don't sell because Bitcoin has dropped significantly. They sell because something fundamental has changed that makes them less confident in Bitcoin's long-term prospects. Maybe there's a technological breakthrough that makes Bitcoin obsolete. Maybe there's a regulatory crackdown that severely limits its utility. Maybe there's a security flaw that undermines confidence in the network. But short of something fundamental changing, they're generally going to hold through the volatility. This brings me to probably the most important difference between wealthy investors and average investors when it comes to Bitcoin crashes. It's not about their strategy or their research or their cash reserves. It's about their mindset and their time horizon. Wealthy investors think in terms of years and decades. Average investors think in terms of days and weeks. This single difference in time horizon completely changes how they perceive crashes. For someone thinking in days and weeks, a significant drop is a disaster. But for someone thinking in years and decades, a significant drop is just noise in the long-term upward trend. Let me put this in perspective. If you look at a chart of Bitcoin's price over its entire history, crashes of 30, 40, even 50% look like tiny blips. They're barely visible on a long-term logarithmic chart. But if you zoom in on any one of those crashes, they look absolutely terrifying in the moment. The difference is your perspective. Are you looking at the day-to-day volatility, or are you looking at the decade-long trend? Wealthy investors understand that volatility is the price you pay for the potential for outsized returns. Bitcoin is volatile because it's new, because it's still figuring out its role in the financial system, because there's still a lot of uncertainty about its future. But that uncertainty and volatility is exactly what creates the opportunity for massive returns. If Bitcoin were stable and predictable, it wouldn't offer the potential for life-changing wealth creation. Now, I want to address something that I know a lot of you are thinking. You're probably thinking that all of this sounds great in theory, but it's much harder to implement in practice. You're thinking that it's easy to say you won't panic during a crash when you're not actually watching your portfolio value drop by tens of thousands of dollars. And you're absolutely right. It is much harder in practice. The emotional pain of watching your money disappear is real and intense. But here's what wealthy investors understand that most people don't. They understand that their emotions are not reliable guides for investment decisions. They understand that fear and panic during a crash are not signals to sell. They're signals that they're human. They're signals that their brain is doing exactly what it evolved to do. But they also understand that they don't have to act on those emotions. Wealthy investors have developed strategies for managing their emotions during crashes. Some of them turn off their portfolio tracking apps. Some of them stop reading financial news. Some of them go for a run or call a friend who understands their investment philosophy. Some of them simply remind themselves of their long-term plan and the reasons they invested in Bitcoin in the first place. The specific strategy doesn't matter as much as the recognition that emotions need to be managed, not followed. Now, let me share something that might be the most important insight of this entire video. The biggest mistake people make during Bitcoin crashes isn't selling at the bottom. The biggest mistake is not having a plan at all. Most people just react emotionally in the moment. They see red numbers and they panic. They hear scary headlines and they get scared. They see other people selling and they follow the crowd. But they never actually thought through what they would do during a crash before it happened. Wealthy investors don't leave this to chance. They have a written plan. They've thought through different scenarios. They've decided in advance how they'll respond to various price levels. They've set aside cash for buying opportunities. They've identified their emotional triggers and developed strategies for managing them. In short, they've done the work beforehand so they don't have to make difficult decisions in the heat of the moment. And here's the beautiful thing about having a plan. When you have a plan, you don't have to make decisions during a crash. You just follow the plan you already made when you were calm and rational. This removes the possibility of making emotional decisions that you'll regret later. Now, I want to be clear about something. I'm not saying that Bitcoin is guaranteed to go up. I'm not saying that every crash is a buying opportunity. I'm not saying that you should blindly buy more Bitcoin no matter what's happening. What I am saying is that wealthy investors approach crashes differently than average investors. They have a plan, they manage their emotions, they focus on fundamentals rather than price. They think in terms of years rather than days. And they view volatility as opportunity rather than threat. And the crazy part is that none of this is rocket science. None of it requires special knowledge or connections or millions of dollars. Anyone can adopt these strategies and this mindset. The difference is that most people won't. Most people will continue to react emotionally to crashes. Most people will continue to buy high and sell low. Most people will continue to let their fear and greed drive their investment decisions. But you don't have to be most people. You can choose to think differently. You can choose to have a plan. You can choose to manage your emotions rather than be controlled by them. You can choose to focus on the long term rather than the short term. You can choose to learn from how wealthy investors approach Bitcoin crashes instead of repeating the same mistakes everyone else makes. The next time Bitcoin crashes, and it will crash again, pay attention to your immediate emotional reaction. Notice the fear and the panic. Then remind yourself that this is just your brain doing what brains do. Then take a step back, breathe, and follow the plan you made when you were calm and rational. Buy if your plan says to buy, hold if your plan says to hold. Sell only if your plan says to sell. Because here's the truth that most people never learn. The people who build real wealth in Bitcoin and in investing generally are not the people who have the best timing or the most sophisticated algorithms or the inside information. The people who build real wealth are the people who can control their emotions and stick to their plan when everyone else is panicking. That's what wealthy investors do during Bitcoin crashes. They stay calm, they follow their plan, they look for opportunities, and they think in terms of years rather than days. And that's exactly what you should do too.